Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrinoto, Global Markets Reporter at Nasdaq. A very special edition of our one-year anniversary for the show, and helping us do that is our partners over at TD Ameritrade. Shawn Cruz is part of the market structure team over at TD. Thank you very much for joining us today. Not only is it Trade Talks' first-year anniversary, it is also the 9-year anniversary of this massive bull run that we've seen.
Absolutely, and it's definitely been, we've seen a lot of our clients get more engaged over the years, and we've seen them be more comfortable not only with getting into equities, but we're also starting to see them branch into other products. So right now we have about 33% of our client activity is in derivatives, which is interesting because that's definitely, we've seen steady growth in that over the years.
Well, you know, it's amazing that you haven't even seen any of these sell-offs stick, and there really is momentum behind this. And we saw it again this week when we got the tariff announcement on Thursday. Stocks just took off and they haven't looked back since. In fact, the Nasdaq Composite hit an all-time high today as well.
Yeah, I would expect there to be a lot more back and forth in the market this year. I don't think we're going to see just as steady gains month over month. And I think it's going to be a little bit more of a stock picker's market, in that you are going to see some sectors perform much better relative to others. I think right now leverage is going to be something a lot of equity investors are going to want to look at. And I think you're starting to see that play out in a little bit of energy, where it hasn't really participated quite as much on the year as you're seeing some of the other sectors.
Well, it was interesting too. We got another great piece of economic data this morning with the jobs number. It totally, blew expectations away. So that also lends to a stronger economy as well, and it seems to be supporting the market right now.
I think so, and I really think what supported this market was not only that strong headline number, but also you saw the wage growth come in actually a little below what I think a lot of economists were expecting. And I don't think the risk in this report was that wage was going to surprise on the downside. I think if you would have seen a surprise on the upside, you might have seen a little bit more volatility. Because I think some people started writing off the last number we got, as well as a little seasonality in that might work itself out. I think if you would have seen that carry over into February, they would have said, well, maybe there really is some strong inflationary pressures building, and is that really going to change how the Fed starts to manage their monetary policy going into 2018?
Right, and that's what I was going to ask you as well. What are your thoughts in terms of the interest rate impact? We have the FOMC meeting on March 21st, where we're going to get that rate decision. It seems to be baked into the market at this point, but we saw when we had the strong employment numbers, the inflation data earlier in February, the interest rate reaction and just the overall equity reaction to it, it's really sensitive to those headlines still.
I think so, and I think the initial reaction was is the Fed behind the curve a little bit as far as inflation? Are they going to really have to tighten policy a lot faster than we were expecting? I think the speed at which they tightened policy was a little bit of the concern there, and I think that just bled over. It started out, in equities that really railed those markets, but we actually didn't see a lot of those high yield. If you looked at what the VIX did, you didn't see the response in the high yield. The high yield actually the spread stayed pretty low, so it wasn't really a concern about the underlying fundamentals of the economy. I think it was really just a concern over what does this mean for inflation, and more importantly, what does this mean for how the Federal Reserve is going to manage monetary policy.
How sustainable is this momentum with the equity market? I mean, we had 2017, it was straight up for the year. You said that you expect volatility to make more of a presence in 2018. Do you think we'll continue to get that momentum in equities as well?
I think it'll show up in some sectors, and it may not be as prevalent in others. So I think if you look at telecom or if you look at energy, there's a lot more risk in that sectors because they carry a lot of leverage. And I think when you start to see that increasing rates, some of those highly leveraged companies might have some issues managing their debt loads. So I would expect them to maybe be a little bit more frothy. But if you look at IT, that's expected to have a pretty smooth trajectory. They're still expecting strong revenue growth and strong earnings growth. So I think that might be a little bit more of a less volatile sector relative to something like energy.
All right, and to wrap up, so we're looking at the Fed, we're looking at interest rates. Are there any other catalysts that you're paying attention to for 2018? I
think there's going to be a lot of headline risk coming out. So I think nobody missed the recent news on the tariffs. That shook things up quite a bit. And now I think markets are realizing maybe they're not going to have as heavy a hand with these tariffs, but there's going to be a lot of wait and see into what exactly they do. They've talked about exemptions, but I think if there's any sort of retaliation from other countries, that could be something that could maybe introduce a little bit more volatility into the markets.
Okay, well, thank you very much for joining us today, and thank you for all the support over the past year to make Trade Talks what it is today.
Absolutely.
And traders, thank you. I'm Jill Malandrinoto, Global Markets Reporter at Nasdaq.